Nifty is showing recovery, Sensex is breathing again towards the upside, and we are seeing rupee has improved against dollar as well. You might think, how come all of a sudden all in one day? The reason here is the announcements that have come from Reserve Bank of India Monetary Policy Committee, and there are 5 very important announcements that have been made that you need to know. Hello everyone, welcome to Vajiram and Ravi's Flash News. My name is Shubhangi Singh, and in today's session we are going to understand those 5 announcements that have been made by RBI and look into what they will change or what is the positive outcome or what remains at risk. So let us begin with understanding that what exactly has happened. So today was the scheduled day where RBI's Monetary Policy Committee meeting was supposed to take place, and in this very meeting we have seen multiple key announcements that have been made. They have been about the repo rate, inflation risk, the GDP, and also how the macroeconomic fundamentals look. Now when we are moving towards the 5 key announcements, let us start very briefly with understanding what exactly is Monetary Policy Committee. Now MPC is the statutory body which is responsible for setting the interest rate, which is responsible for managing the money supply, and it also looks into maintaining price stability. Now the primary functions that it looks into, as I have mentioned, managing the policy rates, then inflation targeting, and it also looks into economic stability. Now this is a statutory body which goes by the name Monetary Policy Committee, and it has 6 members. 3 members are from RBI, and then they have 3 external members which unanimously decide upon the key interest rates which are present. And in this particular meeting, the first announcement that has been made, and that has been made unanimously, that means all have voted for the same, is to keep the repo rate same. The repo rate has been retained at 5.25% and RBI has kept it unchanged. So if you look at this given graph, you will clearly see that how in the recent years we saw the repo rate increasing, but there has been a gradual easing on it, but as of now it has been kept stable. Now to get more clear understanding that how it affects you, let us understand what is repo rate. Simplifying it, repo rate is the interest rate that the commercial banks have to give if they are borrowing from RBI. Simplified as, it is the interest rate that RBI is going to charge from the commercial banks when RBI gives loans to them. Now if commercial banks are taking loans at higher interest rate, then they will pass on those loans at higher interest rate further, and that is going to make your loans costlier, your EMIs bigger. So this very unchanged repo rate shows that your EMIs are going to stay the same. Your EMIs are not going to be affected. The credit will be available at the given interest rate which have been available in the commercial banks. Now the other key interest rates that we look at SDF and MSF, they also remain unchanged in this context. MSF is marginal standing facility. In this context, RBI allows to borrow, like commercial banks to borrow in emergency situations by pledging security. And when we are talking about standing deposit facility, this is also that is a facility available to the commercial banks where they can park their surplus funds with RBI. So here we have SDF at 5%, marginal standing facility at 5.5%. Many of you might be thinking about reverse repo rate here as well, but remember, reverse repo rate is no longer the fundamental operational interest rate based on which RBI absorbs surplus funds. It is SDF. The fixed reverse repo rate that stands is 3.35%. Now this is the key rates that have been announced by RBI. Now when we are looking at these rates, first we have to understand why RBI has done this. Why RBI did not change repo rate. RBI knows that there are rising uncertainties across the globe. We don't know that if we change the interest rate, if we are increasing it, then we are going to curb the demand across, and especially in the times where inflation is right there, imported and domestic as well. This is something that can help increasing the interest rate. But if we lower the interest rates, it might fuel it. But all these are such variable factors as of now that RBI cannot take a long-term stance on this. Apart from that, RBI is very clear that there are crude oil price pressures which are existing. That means the economy overall is under pressure. The inflation is increasing, and if we want to support domestic growth, we can't increase interest rates. We have to ensure that credit remains affordable. So as of now, as an impact, there will be no change in the EMI for borrowers. The predictable borrowing will continue, and this will enable and help the business, and financial markets will be able to, at least will try to stabilize, which we have seen today. Now, the second major announcement that has been made today is that RBI is saying that inflation risks are rising again. So, RBI has said that this financial year's inflation forecast is that it will be increased to 5.1%. As of now, what we are seeing, that current CPI inflation is at 3.48%. Why we are expecting this risk in front of us is because of the imported inflation pressure starkly coming from rising crude oil prices, and then when we link all of it, then we get to see it is the West Asia geopolitical tensions which have disrupted the supply chain, and then we have possible monsoon related. We have to connect the key points here, that El Nino, Super El Nino is also predicted this year. Whenever El Nino is present, monsoon weakens, and monsoon is one of the most important lifelines of our especially agricultural economy, which facilitates our food security. So that is also expected to affect. If the supply in this context will deepen, then the prices are expected to rise here. Now, this particular announcement clearly shows that in coming time we are looking at higher prices, be it fuel prices, be it food prices, be it the manufacturing cost. So, when we look at the first decision of RBI, this is also very much in context of this particular projection. Now, we will be moving to the third key announcement that has been made. That is another important revision that has been done in terms of growth outlook. RBI previously predicted the growth estimate to be around 6.9%. Now they have revised it and put it down to 6.6%. The reason it has been because we are seeing that global demand has decreased. Geopolitical uncertainty is immense. It is not just West Asian geopolitical tension, many other factors. For example, USTR just talked about increased additional duties on 54 countries including India. We don't know if that will be imposed. We don't know if that will not be imposed. So a lot of uncertainty exists. Increased energy cost, increased power demand in our country, and add to that the trade disruptions that exist. So that is why looking at the possibility of downside and the numbers in front of us, this number, growth outlook number, has been revised. But there are still very positive factors where we do not see a huge dip. The dip has been only of 0.3% because this domestic demand remains strong. The service sector is still expanding. Healthy banking system and continued credit growth has also been seen. This is all that has been highlighted by RBI. Now moving to the next major announcement that has been made by RBI, which has been about that what RBI is doing to protect the rupee and ensure the forex reserve stability. In this context, we have to understand that RBI has continuously across last 3 months ensured that rupee is relieved of the pressure, but the external factors have been so high, such as expensive oil imports, global uncertainty, and major capital outflow that India has seen, especially this year. Now, amidst this, what RBI has said that they are going to give better flexibility to NRI deposits, which will bring in foreign currency. Now, that will strengthen forex stability. There will be special forex swap facilities, and there is going to be extended timeline for export earnings realization as well. Apart from that, RBI has also announced going away of capital gains tax for foreign investors. So in this context, the capital outflows are being ensured that they are controlled and steps have been taken to encourage foreign capital inflows. Now, as a result of this, it is expected that in coming times we will have the benefits of better dollar inflow that will ensure that we have stable forex and we are able to ensure the depreciation of rupee is also held on. There will be reduced pressure on rupee if there is proper dollar inflow. The imported inflation might be helped, and forex reserves, which have been heavily spent especially in last 1.5 months, they will also be protected. Now that was all. These were the 5 major announcements that were made. What are your thoughts on this? Let me know in the comment section. That was all from my side. Remember, when we are talking about amidst this also, RBI has shown strong fundamentals where we are talking about better demand, we are talking about the strong growth outlook still at 6.6% and one of the fastest growing economies across the world, which leaves RBI confident but at the same time maintaining a neutral stance across. Now on this note, I'll be leaving you here with the prelims practice question. Look at this question. I'll be waiting for your answers in the comment section. Thank you so much.